People say there's two things you can't avoid in life: death and taxes. But when it comes to real estate investment property, that's not always the case. We'll talk about that coming up next. Hey, what's going on, friends? Nonaka here with the Buy Big Island video blog, and this week we're going to talk about 1031 exchanges. And what 1031 exchanges are is it's a way to defer, not avoid, defer. So maybe the intro wasn't totally accurate, but it's a way to defer paying capital gains taxes, federal capital gains taxes on an investment property. And so what that means is when you sell an investment property, in normal cases, if you make money off of it, you're going to have to pay a capital gains tax on it, and it can be pretty hefty. And I would first always advise you to talk to a tax attorney or a CPA, somebody who's an expert in that area about this whole entire situation in your specific situation. But something that people who own multiple pieces of real estate need to be aware of, especially if they're looking to buy in another market, is the option to do a 1031 exchange, because you can sell a property somewhere else and buy a property here in Hawaii and use the proceeds from that sale tax-free to buy here, as long as it's an investment property. And so that's the important thing to understand here is, if it's your primary residence, this doesn't apply. There are separate exemptions for primary residence. But if it's an investment property, a rental or some other type of investment, and you want to sell it and then not defer, at some point you're gonna have to pay the capital gains, but if you want to defer paying the capital gains on it into the future, you can roll that money into another property and then purchase it, and then you can do that several times throughout the future. But when you're finally done and you cash out, you will be liable for capital gains on that property. So there are some specific processes you have to go through. You have to go through a 1031 exchange company that's going to help do that process and handle the funds. You don't actually get to keep the funds. The funds get held in an account, and then they get rolled over into the next property through escrow. But this is something that's pretty common. We do it a lot of the time. If you have an investment somewhere else, like in your hometown somewhere, and it's a rental, and you'd rather take the equity from that investment and spend it here on a vacation home or a retirement home or something, a part-time home that is an investment. Again, it can't be your primary residence, it has to be an investment. You can do that, and you don't have to pay the capital gains taxes on that sale. Now, there are specific timelines, and this is the downside. Depending on the market, it can cause a constraint in the transfer of those funds, because you have some deadlines you got to meet. So you have to identify up to 3 properties within 45 days of the close of your original investment property, and then you have to close on one of those 3 identified properties within 180 days. So you cannot take forever. You do have to transfer those funds relatively quickly. There is a deadline, and so in a hot market like we're seeing right now, it can be a little bit difficult, because you may not have a lot of inventory where you want to buy, or you may have limited inventory. You don't have a lot of time to shop around. You have to identify within 45 days, and you have to close within 180. So there is a constraint there. That's something to be aware of, but people do it all the time. This is a very common practice here, especially in a second home type market that we're in. And so if you have any questions, you can always reach out, and I'll answer them to the best of my ability. I can help you with the process, the strategy, the timing, and all of that, but the actual specifics of the law and handling the exchange, there are professionals that do that, and I will connect you with those folks to do that. And you definitely want to consult with your CPA and a tax attorney on your specific situation to see what the best fit is for your tax liability and all that good stuff. So, as always, put questions in the comments or email me at dylan@buybigisland.com, and I can answer them. And another big misconception on this is it has to be a like property, right? That's what the code says, it has to be a like property. People think that means, okay, if I own a condo in California, I gotta buy a condo in Hawaii. Or if I own land in Nebraska, I gotta buy land in Hawaii. That's definitely not the case. It just has to be an investment property. Like means investment in the context of a 1031 exchange. So you can sell a 50-acre piece of land in Nebraska and buy a condo here, or buy a home here, a vacation home in Hawaii. It doesn't have to be like in terms of like the property being the same. So that's a common misconception, and again, a tax advisor can confirm that for you and let you know all the specifics. But the main thing is it's an investment property, and you can defer paying those capital gains into the future. So it could be a really big benefit and give you some flexibility in terms of where your real estate investments are made and how you move them around. So again, if you have any questions, put them in the comments. Dylan@buybigisland.com. Thanks for watching. I'll see you guys next week. Aloha.